and welcome. Today, we are diving into Ghana's bold journey to reform the microfinance sector. Our purpose? Simple, to give you a shortcut to understanding this critical financial landscape and unpack the comprehensive set of reform measures designed to transform the sector. These reforms align with the National Microfinance Policy Initiative referenced by the Minister of Finance in the 2026 National Budget. The whole idea is to address current market failures in the microfinance sector and build a financial ecosystem that's more resilient, more inclusive, one that can really restore public trust and drive growth.
Let's start by digging into the challenges this reform is trying to solve.
The sector is highly fragmented, with many small, undercapitalized institutions lacking the strength to absorb shocks or adapt to the fast-changing banking environment. Governance and management often weak. Most institutions are in the form of mom and pop setups with poor internal controls, which are not suitable for commercial deposit taking and lending business. What about mission drift? Many institutions today have moved away from their original inclusion business models towards incommensurate lending and high interest rates, imposing unsustainable burdens on vulnerable clients. Several institutions consistently face reporting and accounting difficulties due to lack of basic internal banking system requirements, while the same or others are stuck in operational inertia, barely growing and simply hanging on in the system with no clear vision or exit ways. These deep structural and operational weaknesses have created a fragile ecosystem marked by persistent losses and eroded public trust.
Just look at these numbers. Back in 2017, the microfinance sector held more than 15% of all banking assets in Ghana.
Fast forward to 2024, and that share has plummeted to just over 8%. Losing nearly half your market share in just 7 years is a huge red flag that deep structural and operational challenges are at play. So what we are working with is the 2011 four-tiered framework. Everything from rural and community banks, savings and loans companies, finance houses, deposit and non-deposit taking microfinance institutions, financial NGOs, and all the way down to individual microcredit lenders and traditional susu collectors. And here's the crucial point about that framework. Its original intent was to solve a very specific problem at the time. There was a rise in unlicensed operators taking advantage of the public. The 2011 framework was designed specifically to identify and categorize players in the sector, formalize and bring oversight to their operations, and most importantly, protect consumers. This reform isn't starting from zero. It's about learning from what works in peer countries and building a better system for Ghana. Here is an important starting fact. Microfinance is a powerful idea. It has helped millions escape poverty, finance education, help businesses and assets.
It's a key enabler and instrumental tool for achieving several of the 17 United Nations Sustainable Development Goals.
So, extensive studies were conducted across West and East Africa, the US, Canada, India, the EU, and several others. They aim to critically examine and compare microfinance system globally and draw the best lessons for designing the next chapter of Ghana's microfinance sector. What were the big lessons from these global examples? What works in microfinance and what doesn't? The analysis pointed to three broad types of institutions operating at the lower end of the banking sector globally. First, market-oriented microfinance institutions, commercially driven, deposit-taking, borrowing to finance operations. Second, socially oriented models, think credit unions or SACCOs, member-owned, community-driven, offering dividends, low interest and flexible lending. Third, hybrid models, rural or community banks, blending commercial goals with social impact, deeply rooted in local communities. What about adoption patterns across countries? For market-oriented models, the data shows two distinct paths. Some countries like Ghana and Nigeria pursued mass licensing approaches, creating fragmented landscapes with numerous small institutions struggling to meet regulatory and prudential standards, amplifying systemic risk. In contrast, countries like Kenya adopted consolidated models with only few heavily capitalized and deeply integrated microfinance banks. The strategy: keep numbers small but institutions strong, enabling easier enforcement of regulatory and supervisory rules. For socially oriented cooperative models, the contrast is stark. Credit union penetration exceeds 65% in the US and covers more than one-third of Kenya's population. Ghana, which pioneered this movement in Africa, lags at just under 5%. That represents a huge amount of untapped potential for cooperative-based financial inclusion. The study also drew fascinating lessons from hybrid models. Take the United States, for example. A staggering 92% of all banks there are community banks. These locally owned institutions are vital, serving over half of all small businesses and demonstrating how commercial focus can successfully blend with deep community roots. And this underdevelopment of the microfinance sector correlates with broader financial indicators. For example, Kenya's credit to GDP ratio is about 32.5% compared to Ghana's 9.3%, and its deposit to GDP ratio is more than double that of Ghana. Kenya also enjoys lower interest rates and has consistently maintained single-digit inflation. This suggests a direct link between high penetration of the right microfinance model, its ability to mobilize savings, extend credit, and create opportunities for citizens across the economy. It shows what's possible when the right framework is in place. Boiling these global lessons down, you arrive at 4 key ideas for a successful microfinance ecosystem. 1. Design a framework that deliberately balances institutional categories to serve different market segments, considering their business models and market characteristics. 2. Drive consolidation and modernization of existing institutions to make them stronger, better governed, and operationally efficient. 3. Promote population penetration through indigenous participation, not only as customers but also as co-owners, providing multiple income streams, dedicated funding, and ease of doing business with commensurate institutions. 4. Build a system supported by strategic industry-level institutional support and centralized services to improve operational efficiency, improve wholesale support, and facilitate policy flow. This brings us to the heart of the proposal, a complete redesign of Ghana's microfinance architecture. And here it is, the new system. Each category has a distinct and complementary role. You've got microfinance banks, community banks, credit unions, and last-mile providers. Each targets a specific market segment and plays a clear role in this new financial ecosystem. First up, microfinance banks. Think of these as the consolidated commercial engine of the sector. The big idea is to enhance or merge many of today's small, weak, market-oriented microfinance players into fewer, stronger microfinance banks. This means more capital, better governance, more expertise, enhanced operations, and the ability to properly finance small and medium-sized businesses. And this idea of consolidation is based on current market dynamics, what's already happening in the sector. Currently, the top 10 institutions across the existing categories control about 75% or more of the total assets, deposits, and credits. The reform builds on this, creating fewer but better capitalized and governed institutions that are stable and competitive. Current owners must join forces and work for the collective good. Next, community banks. This is about upgrading the old rural bank model for the 21st century. The vision is for them to become truly local, Ghanaian-owned banking anchors, serving both urban and rural areas with modern banking and a focus on community development. They will mobilize street street and area-level economic activities integrate communities into the national financial architecture and address financial exclusion in both urban and rural areas. Cities, towns, and villages that can own and support Community Bank will be given the opportunity to do so once they meet the necessary requirements. Third, the plan is to finally unlock the incredible potential of credit unions. How? The Bank of Ghana will for the first time begin licensing and supervising the credit unions based on set thresholds. The aim is to better integrate them into the financial ecosystem and to enable them extend their social and economic reach in a responsible manner. Encourage identifiable work, professional, trade, farm, faith, and other homogeneous groups to form viable financial cooperatives that serve their interests. Finally, last mile providers, Susu collectors, small finance NGOs, VSLAs, etc. The approach here is light touch. Organize them into associations and cooperatives to provide consumer protection and accountability. Holding this entire structure together is a crucial proposal to retool the Apex Bank. ARB Apex Bank Limited was established to enhance the operational efficiency of rural and community banks and deepen financial inclusion. Its current mandate confines assistance to RCBs, leaving other microfinance peers without access to essential services and infrastructure. Under the new architecture, the Apex Bank's mandate will extend to all categories within the sector. It will be recapitalized and restructured as a strategic, sector-wide financial intermediary, delivering centralized banking services and managing payments and clearing, reserves, fund management, and liquidity support. It will consolidate stakeholder and institutional support and facilitate the transmission of monetary, fiscal, and financial inclusion policies. The goal is to position it as a strategic policy tool for sector efficiency, stability, and development. When you put all these pieces together, the new structure and the restructured Apex Bank, what's the ultimate vision? This is not just a regulatory tweak. It's a vision for a new finance and economic reality in Ghana. It is about a financial system that people can trust, a system that guarantees operational resilience and deep participation, where economic policy works better and where capital flows to millions of small businesses and informal workers, the true engine of the economy. The blueprint is here. It is ambitious, comprehensive, and based on what works around the world. But the real test will be execution. Can this new architecture build trust and unlock Ghana's finance and economic potential? The answer will shape the country's future for years to come.